Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for July 13th, 2021. You can believe it, almost halfway through July. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Dean Croak, Principal Industry Analyst, and Ned Damon, who's our Principal Data Scientist. Welcome, guys.
Morning.
Good morning. Morning, Ken.
How was your 4th of July holiday? We didn't get the chance to talk last week. Everything going well?
It was kind of a downer because there weren't any fireworks. All the counties around Portland outlaw. I mean, not to say that everybody in my neighborhood followed those rules, but normally there's a big fireworks show, and that didn't happen this year, so that was kind of a downer.
It's a bummer.
I made up for you, Ned. I was in Cape Coral, Florida, with all of the fireworks that I've never seen fireworks in streets like it. Boat parades, just a lot of celebration down there.
Oh, it was in Florida. That's why. That makes sense.
Yeah.
Not much to catch on fire. It's too humid down there. All right. So for those new to the show, we're here every Tuesday, or at least most Tuesdays at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market. Sometimes we have guests. Sometimes we don't. It's just us this week. And then most importantly, answering your questions. Apparently, we're not on LinkedIn this week, so questions may be light. So if you're joining us on YouTube, maybe that's a little extra incentive to help us out and get us some questions for the end of the show. So with that, I'm going to jump into our key trends of the week because we have a lot of material to cover after being off last week. I'm not going to hit or read all these points because Dean is going to cover them in detail, but the long and short of it is 4th of July holiday happened just about as expected, high volume, scarce capacity, high rates. And then, as you would expect, in the week following, things have fallen off a little bit. Still riding tremendous year-over-year percentage comparisons, which is interesting. TEU import volumes up 30%, but down sequentially. Again, Dean's probably going to cover that in more detail here in a minute. Transportation jobs continues to be an interesting stat to watch. It added just over 24,000 in June. And then Driver Safety Week is underway this week. So with that, I'm going to turn it over to Dean to walk us through our market update. Dean?
Thanks, Ken. Yeah, last week was a short week for shippers, brokers, and carriers. Activity was pretty light on our load board last week. Volumes were down 17%, and now just 18% higher than this time last year. So the gap is closing as we get to that period last year where volumes really took off in July, August. Equipment posts also dropped last week. And carriers took time off, obviously, with a short 4-day week. So the load-to-truck ratio dropped to 6.07 from 6.71. In the refrigerated sector, tracked almost identically to dry van last week. It dropped 17%. The load-to-truck ratio dropped to 12.72, down 15% from 14.21. And in flatbed, load post volumes dropped for the 11th week in a row, now down about 50% month over month. Similarities between 2018 and 21 are striking, as you can see from the chart there. But regardless, flatbed spot market volumes are definitely cooling off. Load-to-truck ratio dropped again this week to 44.11, down from just under 50. And it was only a few weeks ago, or probably 2 months ago, we were up around 110 loads per truck. So big drop off there in a matter of 2 months. Have you look at the market condition index in dry van? Chicago, west of Minneapolis, capacity was very tight last week in reefer and dry van. Spot rates jumped 40 cents a mile to 364. Look further east in Buffalo, spot rates reverse course. They'd been sliding for about 4 months. They were up 40 cents a mile last week to an average of 339. Rates from Atlanta north to Philadelphia, they surged last week up by 55 cents a mile, averaging 423. Interesting stat, that's up an amazing $1.86 since January this year, but it's also reflective of rates in the opposite direction, which have dropped about 52 cents a mile over the same time frame. So a little bit of imbalance on that freight lane. And as Ken mentioned, volumes are up year over year on the West Coast, but on the e-commerce import lane from Los Angeles to Phoenix, where a lot of warehouse freight is staged in the fulfillment centers, rates continue to climb. They reached an average of $4.76 a mile last week. That's up $1.87 since February. So lots of tight capacity on that lane in particular. And in refrigerated, as Ken said, the mid-year peak in produce has come and gone. We ended the year-over-year comps up 3% in terms of truckloads. So we pushed about 1,700 more truckloads into the market last week compared to this time last year. That's great news. Domestic volumes are still down 6%, though. and it's compensated by imports that are up 24%. That's the weekly truckload volumes. From now on in, we typically see produce volumes, these are the weekly truckload volumes, slide by about 21% between now and Thanksgiving. That's what puts some deflationary pressure on the refrigerated spot rate market. So by the time we get to Thanksgiving, carriers will be running about 7,300 fewer weekly truckloads by the time we get to November compared to this week. One of the more amazing charts I looked at yesterday, Atlanta north to Chicago, it's only 716 miles, just over a day. It's a tight run to do it in the same day for some carriers, but spot rates took off last week, up around 50 cents a mile, averaging 361. The more amazing statistic is they're up $1.80 since this time last year, actually double. So spot rates Atlanta north to Chicago are double where they were this time last year. Los Angeles to Las Vegas, where temperatures tied an all-time high temperature record over the weekend at 117 degrees. Lots of demand for refrigerated capacity. Rates held steady at $6.12 per mile. That's northbound from Los Angeles to Vegas, but they jumped 25 cents a mile southbound back to Los Angeles at $5.23. So if you're doing the math with me, that's an average of $5.40 per mile for the round trip of 540 miles. Truly extraordinary rates out west at the moment. And in flatbed, as Ken mentioned, the interstate bridge over Mississippi looks like being opened by the end of July. That's great news for carriers. The delay is down to 15 minutes, so it's fairly good in terms of getting big trucks, mostly eastbound where the delays are. No delays headed westbound. Having a look at some of the data in Memphis, spot rates dropped last week, so capacity is easing as that bridge traffic certainly declines. Rates were down 3 cents a mile to an average of $2.94. Capacity for loads outbound from Memphis to all destinations, pretty tight though on the shorter haul. Decatur, only 400 miles away, average rates are up to $4.18. That's up almost $1 since January. And while we're in Alabama, loads from Birmingham to Chicago hit $4.20 a mile last week in the flatbed sector. That's up almost $2 a mile since January this year, Birmingham to Chicago. Looking at the year-over-year spot rate comps, exhibited some seasonality last week. As Ken said, they dropped immediately in the week after the July 4 weekend. With the exception of last year, rates generally drop off fairly significantly. The short week following Independence Day always reports lower spot market volumes. So dry van rates did exactly that last week, dropped about 1 cent per mile, but with one notable difference. 2021 spot rates are on average 62 cents a mile higher than this time last year and about 72 cents a mile higher than the 5-year post-July 4 average spot rate. So that makes last week's spot rates, 43% higher than the same time over the last 5 years. In refrigerated, after they recorded the biggest gains in volume in the week prior to July 4, they also recorded the largest decrease last week. So rates went up in the week before July 4. They dropped 5 cents a mile last week to an average of $2.78, still 73 cents a mile higher than this time last year. And for context, last week's spot rates in refrigerated are 41% higher than the same period over the last 5 years. And wrapping up with the flatbed market condition index, flatbed spot rates dropped 2 cents a mile last week to an average of $2.73. They've been bouncing around this level since June 27, still 70 cents a mile higher than the same week last year and about 32 cents a mile higher than the same time in 2018. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. So that's it for the report, Ned. Over to you for the short-term forecast, and then we'll...
Howdy, everybody. It's been a hot minute since I've been on the show, so it's nice to be back, and it's time to go through our forecast. We're going to be looking at our short-term forecast, and we're going to be beginning with the van forecast. You can see in blue the market rates observed by DAT. In red, you can see our short-term forecast off to the right there. And then in green, you see our RateCast flagship model, and in gold and silver are our two blended forecasts, which are mixtures of those two in different amounts and in different ways. The short-term forecast is expecting that the sort of overall upward trend is going to keep trending. I'm leaning more towards the standard seasonality reasserting itself, at least going forward for the next couple of weeks. And so I feel like the RateCast model probably has a better picture of what's going on, but we will see. Moving forward to reefer. Reefer is another one where there's a lot of divergence between the forecasts. You can see in blue the market rates observed by DAT. In red, the short term is mostly flat with a little bit of upward pressure, and Ratecast is expecting the slide to continue and then stabilize heading into the middle part of July and August. And the blended forecasts are kind of splitting the difference there. Again, the blended forecasts are in gold and silver. The short term is in red. The Ratecast is in green. Finally, we're moving on to flatbed. In flatbed, you can see the market rates observed by DAT in blue. And then off to the right, there's a lot of model agreement, which is expecting rates to be more or less flat heading forward into the later part of July. And then a little bit of disagreement with the short term in red, expecting them to hold their levels, whereas the Ratecast model in green is expecting more of a little bit of a drop, about 5 cents a mile. And the blended forecasts are leaning more towards Ratecast in the beginning of August. And that will cover our short-term forecast. And we have quite a treat in the long-term forecast, which Ken Adamo is going to be covering. Ken.
Thanks, Ned. Let me just pull it up. Okay, cool. So we've showed these before. I just want to level set everyone on what is going on in this chart, because there's a lot happening. So the blue line, much like the charts Ned just went through, are the historical rates observed by DAT. This just goes back a lot further. It's going back 5+ years. The reason for that is to show multiple freight cycles. When we're looking further forward, just from like a general analytics best practice, you want to look further backwards as well. The gray is the year-over-year change. So for each of the blue data points, including the forecasts looking forward, the gray is the year-over-year comparison in percentage. So that's on the right axis. The right y-axis. The blue dotted line is the Ratecast average forecast. The green dotted line is the Ratecast high, and the red dotted line is the Ratecast low forecast. So what you see is it looks kind of like an EKG. If you kind of like score a line January 1st of this year, rates have been relatively flat on average. They've just been bouncing around quite a bit. So there's been a lot of movement up and down. There just hasn't been a lot of kind of trend movement. They've been rather plateaued. What's Ratecast thinking? So the 52-week Ratecast forecast on average predicts rates holding and then strengthening into the back to school, back to the office, back to college peak, then kind of heading into the retail peak in the fall. Ratecast high is very optimistic about what's going to happen over the next 6 months, and then sort of even heading into 22. Where I'd place my chips if I was a gambler would be the low forecast, which is the red dotted line, which shows rates falling off a bit between now and the retail shipping peak. Still seeing pronounced seasonality for that peak, but then very much falling off after the Christmas season as we head into 22. The one thing I do want to call out here, because I think it's the most interesting thing in the chart, is that we are at the very top, just starting to crest over that ski slope of precarious year-over-year comparisons. Just as recently as a few weeks ago, the year-over-year comparisons for dry van long-haul spot rates were plus 75 to 80% year-over-year. We're currently sitting, if I had to guess, at about 60, between 50 and 60% year-over-year. And in just a few weeks, if things hold steady, we'll be sitting at just 5 to 7% year-over-year comparison. So if you're in your TMS reporting structure, if you're looking at your internal BI tools, and all of a sudden you pull a weekly or a monthly report and you're not showing plus 50% year-over-year revenue per shipment numbers or plus 70%, you're only pulling plus 5 to 7%, the best advice I could give is to not immediately assume that you're charging less, just to assume that you're starting to lap very, very expensive year-over-year prices. Again, any questions you may have, feel free to drop them in the comment section below and we'll answer them. But I believe Dean will be putting this into his weekly market update, so you can go ahead and grab this and throw in any kind of presentation that you may be having internally, or reach out to us directly at askiq@dat.com and we can get this high quality graphic over to you. So with that, I'll turn it over to Ned for our Ask IQ question of the week.
Oh boy. Let me pull up the exact language, and that is, what's happening with Class 8 truck orders? What is happening with Class 8 truck orders?
Yeah, I can just get it started here. Some of the data that FTR pushed out this week. June orders were up 13% to 26,700. The comps are a little bit ridiculous at 71% year over year. The interesting news is that it's a very positive result because the 24,500 or 26,700 is about double, I think, where the typical low point is for this time of the year. So there's still strong demand. FTR expect a surge in orders when OEMs start opening up their 2022 order book. So some of the downward movement we saw in new orders in April, May, early June are reflective of the fact that build slots for 2021 were fairly limited, if available at all, and OEMs hadn't opened up the build slots for 2022. They think this could happen as early as July. So one of the commentaries I saw from the folks at FTR was that they expect that July could be another record level month, which is just staggering when you think about where we've been. So yeah, good. The outlook is pretty good. There's still lots of shortages in lots of sectors, though, in terms of getting equipment on the road. So there's, but strong demand in terms of where we are with the order numbers.
Yeah,
I think. Go ahead, Ned.
Oh, I was going to say, it's interesting that we're having some of the commentary that I've been seeing has been about the difficulty of getting drivers, like butts in seats, as far as actually moving this equipment. Do you think that there's a certain amount of this ordering that is essentially prophylactic, where they're doing it because they want to make sure that they can have the equipment if they need it, and that whether the sort of open question about whether or not this equipment is going to actually hit the road?
It's both. I think there's that, plus it's also a driver retention tool.
Mm-hmm.
You know, a lot of fleets will bring new equipment into their books as a way to keep and recruit new drivers, take advantage of all the latest technology, especially on the safety front. The things like adaptive cruise control, collision avoidance technology, great technologies for new entrant drivers in the industry. So it's a really good recruiting tool. So there's partly that. There's also just this need to increase capacity in the market to take advantage of the surging volumes.
Right. Yeah, but your take would be not 100% of these trucks are entering as new equipment. There's a fair amount of this that is going to be essentially replacing old equipment.
Oh yeah. Probably about 50%. I mean, rough average would be 50%. Is what I would expect. Now, the further this drags on, I think the most remarkable number in the FTR report is trailing 12-month Class 8 truck orders. 431,000 units.
Mm-hmm. Yep.
And I agree with the commentary, not just from FTR, but ACT also puts out. ACT, they put out Class A truck orders. I think the general consensus, right, is even if the order books were open for 21, they were feasibly not open, right? I mean, you weren't going to take delivery, so why not wait to get in on a good slot in 22 delivery? So I subscribe to the notion that there is a ton of pent-up demand, and you will see July, August, September orders kind of shoot up. And even though, right, Class A truck orders weren't, like if you look at the graphic, it doesn't look as impressive as January, February, March, and April. It's still up 71% year over year compared to June of last year. So, I mean, look, carriers are going to buy too many trucks. I mean, that's not a hot take. That's not a Stephen A. Smith take right here. It's going to happen. It's happened every year and a half, like clockwork since 1980. Mm-hmm. The question just becomes like, when does that hit the road, or are the drivers going to keep up with that, and all of those sort of big macro, factors that play into all of this.
I mean, there's also sorry, go ahead, Dean.
I was just going to say the other side of this is the retail prices. Like, so there's one is the order side of it. Then there's the current demand, and retail pricing's at or above any period in the last 12 years following the Great Recession. So Class 8 retail prices continue to accelerate, especially for sleeper tractors. The other data point I looked at was JD Power's auction inventory data, which to me is a really good indicator of where capacity's at and how quickly it's entering or exit the industry. Last year, in July last year, auction inventories, these are Class 8 sleeper tractors that are being sold through the big auctions. So the number of trucks at auctions last July peaked at about 1,050, which was right after we saw record bankruptcies in Q2 of last year. last month it's down to 200. So the number of trucks being sold in inventory is down 81% since June last year. So that's a really good sign that demand is tight. Prices for trucks at auction are up about 12% in June. So there's still strong demand in terms of carriers adding capacity, both in the trucks that are available on lots and also trucks available in the used market.
Yeah, speaking of price, the inflation numbers came out this morning, just before we went live. And I mean, look, I'm not an economist and I don't even play one on television, but it is terrifying. Not core CPI saw the highest increase in over 30 years.
It was like 10% annualized.
I think it was, yeah. I mean, I thought it was even higher than that for core.
Yeah.
It is, and that's even including the way that they kind of inherently sandbag the calculation. Highest in 13 years from a total CPI perspective. Yeah, up 4.5% over the last 12 months, which is the biggest increase in 30 years. So, record prices for used cars accounted for more than a third of the overall rise in prices. Used car prices were up 10.5% in June and a stunning 45.2% in the last 12 months. So,
Ken, that's flowing over into the smaller, service vehicles. So as the service economy opens up, people in the construction industry, home cleaners, other service-based they're really struggling to get newer vehicles because automakers are prioritizing, they're building pricey trucks and SUVs for individual buyers, which is kind of leaving commercial fleets out in the cold. So there's capacity even tightening in the smaller vehicles as the service economy opens back up.
Oh, I'm familiar. I just bought a new F-150 this weekend. Trust me, I'm very painfully familiar of that fact.
Yeah.
I was able to sell a lease. Right? I sold my lease to one of those online car dealer companies for like $3,500 more than what I had left with my payoff in 2 months, which is, that's just unheard of. It's a lease, right? So none of it makes any sense. The best thing I think you can do is just try not to understand it. It'll give yourself a headache.
One more comment on that before we head on, and that's my understanding is that's heavily the used car price increases and the shortage of vehicles is heavily driven by continuing semiconductor shortages. Is that your folks' understanding as well, or is the snake through the pig through the snake?
I think it's part of it. I play basketball with a guy that does a lot of the kind of regional auction type stuff for the wholesalers, that the dealer to dealer type stuff. Mm-hmm. I think that's just part of it. I think it's like a huge pent up demand. He said a close approximation of demand would be double because during COVID, no one was really buying cars, and now there's kind of double the demand. Definitely the lack of used cars is the primary driver. The lack of new car inventory is the primary driver for used cars, but there's just a ton of things playing into that right now. They're making them slower due to lingering issues, and it's just hard to play catch up. It's resins as well. It's not just semiconductors. There's literally instances, talking to this person, and this could be isolated, but I suspect it's not, of dealers buying other dealers' inventory at retail price and then selling them at a markup on their own lot. So a lot of these dealers have started to almost play isolationism to prevent that from happening. So I don't think there's really any kind of 45% increase. I think there's no one single variable that's going to be at play there. Just my perspective.
All right.
Want to hit us with some questions?
Yes. Yep. David Matheson asks, can you talk about the executive order on railroads and vessels? Generally speaking, on the apps.
Is that the Surface Transportation Board?
It's the one encouraging. Yes, the one encouraging people to do competitor bids on railroads.
I thought a big part of that too, again, I'm just speaking out of what I've heard snippets in the news. I thought a part of it too was to allow passenger rail more open access to the freight rails.
That may be. I would need to do a little more research on that. I know.
Yeah, we could take that away for next week.
I know.
Let's make a note for our Ask IQ question.
Amtrak.
I don't think I've ever been on an Amtrak.
I have. It's quite nice. In the Northeast Corridor, at least. I don't recommend it out west, but
It's a lot of
Northeast.
Yep.
Recommend. Stephen Linton says, do we have longer-term information for Reaper? Yes. Rising inflection.
We do. We've been having some issues with our internal reporting things, and it's been very difficult to run. So I only pulled dry van. If you're interested, we can get reefer pulled perhaps for next week. Hopefully things resolve on the reporting engine front.
Matt Clark, I heard you say that produce season is over in the West. What about in the South?
Yeah, I'm not sure I said that. If I did, that's certainly not the case. Produce season isn't over by a long way, but it's certainly not out west and certainly not in the south. It certainly is in Florida in terms of high volumes. I think the general consensus is that there's a peak in produce shipments that occur around July 4, but then it tapers off after that on both the import and the domestic front. So produce season isn't over by a long shot. If anything, though, Matt, it'll shift further north as we get further into summer. So we'll typically see markets like, Twin Falls, Idaho, Pendleton, Oregon markets start to come online with some of the produce. We're starting to see some of the summer produce come online around New Jersey. So as the summer goes on, it moves further north, but certainly not over by a long shot. But peak volume certainly has passed.
David Matheson asks, any Southeast China port update and timing of the influx of potential vessels at Long Beach?
Yeah, I could. I've got some data here from the Marine Exchange. I'll just quickly pull that up. The latest report yesterday showed there were 17 ships at anchor, 17 container ships at anchor, of which that's 2 more than yesterday. So 17 container ships at anchor, 28 at berth. That's the same yesterday. In terms of where we are year-over-year comps, we're still 17 at anchor is still about 17 more than where it normally is this time of the year. But the thing that's happening that is very difficult for the port to handle is that there's 49 vessels scheduled to arrive over the next 3 days. That's 12 more than normal based on pre-COVID levels. And what you see is some days it's very spiky, as Kip says at the Marine Exchange. You'll see 10 one day, 3 the next, 2 the next. So there's inconsistency in the vessels arriving, which of course is stemming from a lot of those delays in South China due to the recent COVID outbreak at the Yanshan port.
And that is it for the questions. Do we want to switch to wrap up, or is there any shout out?
We had one from Gary. I don't know. Did we already hit that one? Was I daydreaming?
No, you're not. I just skipped over it. Sorry. Gary Bates, hypothetically, if I am a carrier and a broker, how much percentage should I take off of the load as the broker?
I like his question. That's why I wanted to bring it on.
That was just slipped my mind.
No, for sure. So I'll open, and then maybe you guys can, just because I've lived in that world for so long. So I would focus less about percentage. I think the brokers, one of the ways you could segment brokers is by the way that they price. And I think, again, not a hot take. So today's episode theme should be no hot takes. This is very much a tepid take. The brokers that do cost plus pricing perform as an aggregate worse than brokers that think about kind of price as a holistic unit for the lane or the set of lanes or the basket of shipments that they're trying to handle. What I mean by that is brokers that have a process where they go, they have a shipment from their shipper, they go find what it's going to cost to move it and apply an arbitrary margin percentage on top of that. And our industry, depending on where we are in the given freight cycle, what's happening, that number can range from 14.5%. I've seen it go as high as 16.5%, pushing 17%. They perform on average worse. And what I mean by worse, they may lag behind other brokers in terms of volume. So when the market's really rocking and rolling and margin and volumes are up 10%, they may only be up 6 or 7%. They also respond slower to market changes, right? So if you're only applying a fixed margin on top of cost, you naturally aren't going to capture the pricing changes as fast as brokers that are thinking about price holistically. So what does it mean to think about price holistically? What do I want to move this shipment for? So let's just say in a perfect world for us, you're a rate view customer and you're looking at all the shipments moved on that lane and what your historical margins have been and maybe like what you've won and lost freight at. And you agree to a price with a shipper and then you go start to work it with your carrier. That's going to do a bunch of different things. One, it's going to cause you to be market in line with the market on the shipper side. But also, when you turn it over to your operations folks to go cover it, they're now trying to reverse engineer, and they may make one extra call or two extra calls to different carriers to try to get, a more market appropriate cost, which will result in better margins and then better efficiency on the sell side. So that's a long way to say I would think about things as being very efficient on the buy and sell side and tuning those both separately, as opposed to just trying to kind of goal seek for a flat margin on top of a cost. But anything else I missed?
I mean, I hear you, but I also, I think the advice that you gave, that it varies a lot, is appropriate. Is that there's not a magic level, but taking this into account is important.
Yeah. I don't know that you should be applying the same margin percentage on head hauls as back hauls. Right? I think you will get less backhaul shit. Especially like if you're thinking about yourself as a carrier, if you're looking at a broker and you're trying to move a carrier, right? So it all depends on like what the situation is too. Like if you have a carrier that's in your book that you're trying to help build a relationship with, and they call you and they're trying to get a load out. Like if you're in that situation, I would advise being more aggressive on the price side because you're trying to secure the shipment. If a shipper calls you and you're one of 5 or 6 brokers they're shopping around for, trying to get a load covered, you might want to be a little bit more conservative and add a little bit more padding in your price, because you know that you're one of many competing to get that shipment covered, which means it must be a difficult load to cover. If all you did was assume a cost and apply a percentage, you're essentially not giving yourself any flexibility to be more or less aggressive on a shipment by shipment basis.
There's this follow-up from Gary. Should it be 14% financially or 20% or as much as I can get?
So I guess maybe I was doing a bad job of communicating it. I think what I'm trying to say is there is no magic percentage. If you're targeting a percentage, I would argue that you're doing it wrong. I would say that the best outcome on a shipment by shipment level is to charge what a shipper is willing to pay and cover for what a trucker is willing to accept. And on average, that will likely wash out to about between 15 to 16.5% on an industry average, right? If you look at the $80 to $100 billion of freight every year that's brokered, that's the average. But it is a distribution. It is a bell curve. Actually, it's probably a log normal curve, if we're being honest. But think of it as a bell curve. Some shipments, let's just be honest, it's not price gouging. Some shipments have very high margins, 30, 40, 50%. Some shipments have negative margins. The hardest thing when I was in the industry, the hardest thing to get a sales leader to believe is that they should lose money on some shipments. And for some, that's never going to work. And those brokers will never become as successful as the top 100. That's kind of tough, real talk, but it's just the way that it is, right? The most successful brokers in the industry have a portfolio of better and worse margins. And this is the way that it is.
Yeah. And to that point, do you think that targeting margin is like a KPI for your floor brokers is something that's going to be overall harmful in terms of that, or?
I do. Again, I don't know that it's going to cause you to go out of business. I do think it'll stunt your growth. It's like drinking coffee as a teenager, right? It's like, I think you will not be as successful as brokers that are thinking about price and cost differently. So what caused the kind of influx of the it used to be a much more concentrated group of brokers at the top. Now we're over $10 billion brokers, right? And the top 20 are all very, very large companies. When I think of large companies, the 20th largest broker when I started in this industry didn't have an HR department. They were probably still using QuickBooks, right? So the industry has grown because they've bifurcated price and cost. And they have separate teams. The biggest ones have separate divisions thinking about price and cost differently. I'm not saying you have to go to that end of the spectrum. Even if you were a single broker operating as an agent for one of the big agency models, if you inject the thinking of the way the big brokers do it and separate price and cost in your head, I think you will be better off. You will be a much more effective broker than if you just say, I'm going to put all of my energy in figuring out what the cost is going to be and then just apply an arbitrary percentage margin on top of it. Just think of the way that sounds. Is that how you want to it's like you're getting all the way there and then you're just sort of throwing your hands up in the air at the most important part, in my opinion. You've been quiet, Dean. Any kind of final thoughts before we wrap?
More of a philosophical approach. I always use the same methodology I use with buying and selling stocks or houses, and that is I always leave something in it for the next person, so there's some perceived value. If you're always trying to sell at the high point and buy at the low, you're playing against much higher odds. So I always try to I always try to leave something in it for the next person, and just understand that over the long run it'll even out. You've always got to leave some value for the person you're negotiating with.
Yeah,
for sure.
And even if you're not being altruistic like Dear Dean is, I would say that you are not going to be able to time things perfectly.
Right.
And that point of view of leaving something in is going to be an advantage to you because you are not trying to time it. You are trying to give yourself that safety margin.
Yeah, I mean, the cost of calling that extra carrier to get $50 less for that shipment could be they show up to the dock and they're using a push broom to get stale cabbage out of the back. I mean, not that I have any experience with that. All right, I do have to wrap us up here. So housekeeping items, Freightvine podcast, highly recommend you to check that out. We'll have more information about this in the coming weeks, but we will be opening up registration for DAT Con 21. If you're not familiar, that's our big user conference. It's going to be in Austin, Texas this year. Everyone on this a little video program is going to be there live. There's a bunch of other DATers that are going to be there. Some really cool folks from in the industry. It's a really great event. I went a bunch of times as a customer and did some speaking engagements. This will be my first time going as an employee because we had to cancel it last year. So I highly recommend checking that out when registration goes live. It's not super expensive. Austin City Limits is happening at the same time while we're down there. It's on the University of Texas at Austin's campus. What's that, Ned?
I wasn't sure that you could say that. Because that implies the dates.
Oh, I think the dates are set. Who cares?
Okay, all right.
All right. So with that, I am going to wrap us up because we went long, but it was a really good discussion this week. I want to thank everyone for joining us on the questions, and we will be back next week at the same time to answer your questions and talk about the freight markets. Bye, everyone.
Bye.